Hey traders, in today's video we'll be explaining exactly how to use Heikin Ashi candles as well as an effective Heikin Ashi trading strategy. Let's get into it. So the number one question people ask when they first see a Heikin Ashi chart is always, how is this different to a regular candlestick chart? Both of these charts look similar in appearance, yet they each have different uses and different ways of being calculated. The way a traditional candlestick chart is calculated is incredibly simple. The open, high, low and close values are all taken as the price of the asset changes over time. Past candles have absolutely no impact on the formation of current candles, but this is where Heikin Ashi candles differ. Heikin Ashi candles are actually calculated using information from the previous candle. The open of a Heikin Ashi candle is calculated by taking the average of the open and close price of the previous candle. This is very easy to see on the chart as each Heikin Ashi candle opens at exactly 50% of the previous candle's body. The close of a Heikin Ashi candle is calculated by taking the average of the high, low, open and close of the current period. The high is calculated by taking the high, open and close of the current period and choosing the maximum value out of the three. And the low is calculated by taking the low, open and close of the current period and choosing the minimum value. Heikin Ashi candles are typically used to smooth out price action, eliminate noise, and make it much easier to identify trends in the market. A typical uptrend using regular candlesticks will likely have a mix of both red and green candles. For example, looking at this chart, at this point in time we're in a short-term uptrend. We have a small consolidation at the bottom, we have a strong green candle followed by a red candle, then a series of green candles followed by another red candle, and finally another series of green candles before the uptrend ended. This is typical price movement on a regular candlestick chart. Just because we're in an uptrend, it doesn't mean 100% of the candles will be green. It's normal to see pullbacks along the way, which come in the form of these red candles. However, if we look at a Heikin Ashi chart during this exact same period of time, you can see that things look very different. We have the same small consolidation at the bottom, but the uptrend consists of only green candles before it ends at the top here. This is why it's much easier to see trends on a Heikin Ashi chart when compared to a regular candlestick chart. When we're in a strong uptrend, there are two main things you'll want to look out for on the Heikin Ashi candles. The first is a large green body. Now for those who are new to using candlestick charts, the body is simply the thicker part of the candle, whereas the wicks are the very thin parts on the top and bottom. So when we see a large green body on a Heikin Ashi candle, this indicates that we're in a strong uptrend. And the second thing we'll look out for is no lower wicks on these green candles. Both of these criteria occurring together indicate a strong uptrend. Similarly, when looking for a downtrend on a Heikin Ashi chart, we'll want to look out for 1. Large red candle bodies, and 2. No upper wicks on these candles. Both of these criteria occurring together indicate a strong downtrend. You'll often see these smaller candles on a Heikin Ashi chart where we have a small body and both upper and lower wicks. These kinds of candles will represent one of two things. If we see a series of these candles in a row, then that indicates that we're in a ranging market, meaning that neither buyers or sellers are in control, and for the most part, price is moving sideways without any significant moves to the upside or downside. If we see one of these candles during an uptrend or downtrend, then this indicates indecision in the market. However, it's important to note that this is definitely not a sign of a guaranteed reversal. If you sell every time one of these candles appears during an uptrend expecting a reversal, then you'll likely have many losing trades. It's quite common to see a strong uptrend, a small pause, and then a continuation of that uptrend. Okay, now it's time to take everything we've learned so far about the Heikin Ashi candles and turn it into a tradable strategy. So the first step of this strategy is going to be to identify a high probability level of support or resistance. We have a past video on this channel showing you exactly how to do this. So once we've identified this level, we're going to draw it in on our charts. Here we have a market that is moving down into a level of strong support. We touch this level for the first time here on these two red candles. Next, we see two smaller candles with wicks at either end. Now remember from earlier in the video, this shows indecision in the market. So we're going to wait for a strong bullish signal before we enter the trade. Next, we see a large green candle form. However, this is not a strong bullish signal. We need to see a candle with, number 1, a large green body, and number 2, no lower wick. This candle has a small green body and wicks on both ends, so we would simply sit back and wait. We have a second push down into support here, and again we see these small candles form with wicks on either end. We then see our first larger bodied green candle form with no lower wick. This is the first signal we see of bullish pressure entering the market. Now, depending on your level of risk tolerance, you may wish to enter on the close of this candle. The body of this candle is larger than the majority of candles that have formed since touching support. However, it's not overly large, so you may wish to wait for a stronger bullish signal before entering. Price begins moving further up and we see two more large-bodied green candles form with no lower wicks. Finally, we see this massive green candle form. This candle breaks above the short-term level of resistance we see on the left. This is a very strong bullish signal. We've broken above resistance and we have a large-bodied green candle with no lower wick. So this would be an excellent place to enter a buy trade. We then see strong upwards momentum come into the market as price surges up. Eventually, we hit a level of resistance and the size of the candles once again gets smaller. When we see the first red candle form, this would be our signal to close the trade position. Now at this point in time, there is a possibility that price will pull back and continue even higher. But we recommend closing at least a portion of your trade on the first sign of bearish pressure coming into the market. If we were looking to take a sell trade for this strategy, then we would wait for price to move up into a level of strong resistance. And similar to before, we would wait for the first sign of strong bearish pressure to come into the market. This would be our signal to enter a sell trade, and then we would wait for the first green candle to form after price has moved down before closing the position. An alternative method of trade management you can use before closing your position is to wait for strong bullish pressure to enter the market. In this case, we would keep the trade open even if we see small green candles or indecision candles. But on the first green candle that appears that has a large body and no lower wick, then we would close our sell position.